morning, everyone. I'm excited to host this session. Patrick, our CIO, has more than 30 years of investment experience and will have a lot to share in this short 5 to 10 minutes. Good morning, Patrick.
Morning, Grace.
Hi. Let's start with a recap of 2021, shall we?
Sure.
2021 has been a challenging year for investors.
Yes.
We have had to navigate many unprecedented events, including Chinese regulatory changes, COVID uncertainty and fatigue, as well as Fed tapering expectations. What is your take for 2021?
Thanks, Grace. Certainly, 2021, last year, was an eventful and challenging year. I think with regards to China regulatory environment, that has impacted the communication services as well as the real estate sector. As for the real estate sector, the deleveraging as well as the tightening of liquidity there has caused a number of defaults. In fact, Asian high yield registered 13% default rate, and that's the highest, substantially higher than any default in the last 10 years. While Asian equities last year also had, experienced a recovery of earnings, but unfortunately suffered a huge derating. Last year was also a year of huge divergence. Asia, which was weighed down by China, registered -5%, while the developed markets, based on easy monetary policy and strong capital flows, registered +22%. So you see a huge divergence there. As well as we saw huge divergences in performances within sector, across sectors, as across countries as well. So what we, as investors, we would need to position for these trends as well as the dynamics. And also to be mindful of the compression of the cycle. We have also seen a compression of cycles, and at certain times, there's also sharp rotation between sectors.
Yeah, that's right. I remember having many interesting conversations with our colleagues across the various asset classes.
Yes.
In that context, how do you think the investment team adapted to this?
Yes, maybe let me share two developments at Fullerton. I think 3 years ago, we expanded our equity coverage, research coverage from Asia to global. And why is that the case? I think that allows us to expand our opportunity sets as well as to reduce some of this impact from, say, single country regulations such as China. But 2019, we also launched the Global Absolute Return Equity Fund. And that has done well in terms of performance as AUM, which is a testimony to the approach that we take to the market in these changing times. And for multi-asset portfolio, we have broadened our asset allocation coverage to diversifying somewhat away from Asia. So that is the first development. Second is that we focus more on the absolute return focused strategies in equities. So that means that we are able to conduct in-depth research into companies' businesses, companies' business strategy, management, as well as, earlier on we talked about ESG, right? ESG factors. And that will enable us to make a quick decision in terms of construct of our portfolios and the companies that we want to place within our portfolios. Yeah.
That's great. I think with an expanded toolbox, we certainly will have more exciting developments in terms of strengthening our investment process and continue to offer solutions to our clients. Let's move on to 2022 then.
Yeah.
It's only been, 12 days, but it feels like a lot has happened.
Certainly.
Yeah, I think inflation continues to preoccupy investors' mind.
Yes.
Yesterday, FT reported that inflation was the highest in 25 years.
Yes. Okay.
So I think as consumers ourselves, we have been impacted by this. What is your take on the central bank and government's response on policy front?
Right. I think inflation, yes, we certainly, all of us experience, inflation. I think one of the key factors that has driven inflation is certainly, governments or central banks that have had kept interest rates, right, nominal interest rates for low for too long, as well as even if you look at the markets, right, the real interest rate in the market is, some are negative even. So that is one of the contributing factors. And why is that so? what are the reasons behind some of these policy actions? Firstly, certainly we talk about COVID, right? There's a lot of concerns about COVID's impact on growth. And secondly, generally, they are more concerned about how, untelegraphed increase in interest rate could impact the markets. And some of these markets are already, in certain sense, extend into overvalued territory. Third reason is for debt servicing. Because of the COVID situation, governments of the world has increased debt. So debt level has increased, tremendously, and this is the highest increase in peacetime.
Yes,
right?
that's right.
Generally, in wartime, you would increase government debt to finance the war. But if you look back into the history, and peacetime is the largest. So debt servicing, in some sense, the central banks will be motivated to have interest rate at a low level for debt sustainability. And I think what we see in today's context, right, is that we are witnessing late cycle dynamics and supply bottlenecks. Just now, Ken talked about people have to pay up because of supply, right, limitations. And rising commodity prices as well as house prices. That led to, and coupled with a tight labor market, we have wage inflation. And all this put together means that we have entrenched higher inflation expectations. The only action I think central banks will need to do is that they will have to hike rates earlier on. So our expectation is that the Fed will hike rates 25 basis points in March for the entire year of 2022, perhaps 3 hikes of totaling 75 basis points, or quite likely a fourth hike. So could be between 75 and 100 basis points. Quantitative easing will stop by March, and they will have to reduce the balance sheet sometime. Our expectation is perhaps in the second quarter or in the third quarter. Yeah.
Well, that does sound like a lot. I think it wasn't too long ago that everyone was thinking the rate hikes will only happen in 2023. Look where we are today.
Yes.
Maybe at this juncture, it will be interesting to have a look at the poll question.
Yes.
Just to recap, the question was, which of the asset classes is your most positive? Are you most positive in 2022?
Right.
Well, it looks like our audience is still very upbeat.
On
Equities is
yes.
By far the winner.
Yes.
What do you think, Patrick?
Okay, I think that generally I would say that for investors or our clients, the expectations for which asset class would perform the best would be based on their assessment of macroeconomic factors and their risk appetite in terms of how much volatilities they can stomach and draw down in the market, as well as investment time horizon. So of course, if you have a longer time horizon, equities is great, right? And in terms of commodities, it could be a good hedge against the inflation. And some would believe in the commodity super cycle as well, right? But I think that for us at Fullerton, what we want to advocate is a broader asset allocation strategy, which is a multi-asset sort of strategy that comprises fixed income with government and credit, equities, Asian and global, alternatives. Hakim talked about funds, private equities, right? Private equities, as well as, let's say, gold, right? Could be a good hedge. So this is how we view things at Fullerton, and that need to be supported by a very strong research platform for which you are responsible for. So we have, asset allocation macro strategy, and Robert, our strategist, which we heard him moderate some of these sessions. He's responsible together with the multi-asset team. We have interest rate and credit research, as well as we have equity security research. And now we have ESG, AI, data analytics, as well as thematics. So we need to put all this research that we have at Fullerton together to enable us to navigate the kind of markets that we're going to see, right? Yeah.
Sounds
and
like...
of course, maybe I just add that since many has chosen the equities strategy. In that area, we would advocate a high focused equity strategy of, like our portfolios are constructed 30 to 40 stock. That is that you are able to, rather than a diversified or passive strategy, so you can conduct in-depth research and navigate the markets better.
It does sound like you're also cautiously optimistic on the market, am I right?
In some way, yes, certainly.
Could you summarize your outlook for 2022 for our audience?
Okay, for 2022, certainly macro headwinds is something that we are aware of, rising interest rate, falling liquidity, as well as intensified competition between the US and China. And there are also geopolitical development in Russia and Ukraine. Of course, Omicron and the virus situation may reverse at the margin. So on world markets, just to bring the aspect, the global markets have 3 consecutive years of double-digit returns, accumulating to 72%. Last year, we have not seen any correction that is, say, more than about the 5% mark, quite shallow. So if we map it back to the mid-cycle in 2014 and 2015, we could see a bit more volatility, hence quite cautious. But I think what we are positive about is US growth is still above trend. China policies are to stabilize growth at around 5%. And on the company level, I think there are opportunities in the area of metaverse, innovations. And of course, on the PE side, I talk about COVID situation has dampened some of the valuation in some of these investments in the area of consumer and services. So that could provide us an opportunity to look at them in it's quite interesting valuation to enter that. Yeah.
Sounds like we have an exciting year ahead of us. Yeah. I see that we have some time left. Maybe we can look at some of the Q&A questions.
Yeah. I think one of them is, how will COVID impact your investment strategy in 2022?
Yes, that's right.
Yeah.
I think COVID is still very much on our minds.
Yes. Maybe I can address that. I think, after sort of Dr. Leong's positive view on that, I think that near term, the impact is probably negative because we are seeing tighter controls that is curtailing somewhat economic activities. And the headline news on the rising cases also might cause volatilities in the market. But what we'll say is that we are into the 3rd year of COVID, right?
Yes.
We have high vaccination rate. So I think generally market would like to price for a positive development. So I'm in that camp. I think that, we would not, because of, I think, factoring COVID too much into our investment, but just to navigate the volatilities that the COVID situation can continue to cause. Yeah. I think one of the other questions is how should we balance public and private markets investment in our portfolio? I think earlier on I spoke about, at Fullerton, like we have, research across the spectrum, public markets as well as private markets. I think that it's really dependent on investors' preference for liquidity as well as longer term returns. So for investors, we have launched private equities funds that cater to investors that are able to have a longer term horizon while they look for a higher return. While the public markets do, provide a good source of liquidity. You can, sell out your funds, right, at any time that you want. And most of our funds are traded on a daily basis. So, but within client multi-asset portfolio construction, if when we manage, of course, the tilt is still more towards the public securities, and then a smaller portion towards private markets, and that would enable us to, to produce a more balance in terms of liquidity as well as in terms of the returns that the portfolio can look towards.
Yeah, I'm glad that we have a range of solutions
Yes.
for our clients. Maybe we can take one last question. There was a question, I believe, on sustainability. How do you think about sustainability and investments?
Yeah, I think at Fullerton on sustainability, we want to focus on research as well as engagement and risk mitigation. So I think we have invested in an ESG team that will drive this area, and analysts will have to analyze companies on ESG considerations. Portfolio managers will construct portfolio based on the ESG quality, and that is a risk mitigation strategy. So we will continue to develop in this area with more resources, more research, and provide solutions for our clients as well. Yeah.
Okay. Thank you very much, Patrick. Thank you, audience. Please direct your questions to your client contact. I'm sorry we didn't have time to address all of your questions. Thank you.
Thank you. Thank you all.
This brings us to the end of our webinar. I think first and foremost, our Fullerton would really like to thank all the experts that we had today. We really appreciate them sharing their views very candidly. I think it made a very informative and very engaging webinar. We would also like to, of course, thank our clients. Thank you very much for your support. We hope that you got some key takeaways from this webinar today, and hopefully some of the insights will help you in your investment decisions. I'd just like to take a few minutes just to summarize, I think, 4 key takeaways that cover COVID, climate, and China. I think when it comes to COVID, there's still a lot of uncertainty, but I guess the key message that we got to take away was that there is a lot of positive news for investors looking forward in terms of the battle against COVID. And perhaps more importantly, what COVID has actually done is change spending patterns, and that is what's actually opened up investment opportunities. So whether that is more consumerism in the metaverse, or whether that is governments spending more on healthcare, there are sector benefits from these spending changes. The other thing, of course, is climate. Climate investing is becoming increasingly important. We heard that it is going to underpin infrastructure investment across Asia and especially in China. We also know that from the ESG side of things, thematic investing is becoming much more important. What I would say on China is that it is quite difficult, I think, for investors to think about pricing in the uncertainty surrounding the domestic policy changes in China, as well as China's external relationships. But I think what we saw from our poll question is that investors are quite optimistic, cautiously optimistic on returns in China. And we also heard from the Fullerton team that yes, we are positive on global risk assets, but we also see opportunities in China. And if we take a sector view, we see that there is promising returns perhaps from consumer-based products, from financials, from new industrials, of course from climate-related renewables, and of course healthcare. And I guess there is actually a 4th C, which is what I think Patrick, our CIO, focused on today, and that is challenging. It is a challenging macro environment that we have been facing for the last 6 months, and that is going to continue into this year. We have high inflation, we have earnings growth that is slowing, liquidity is tightening, and interest rates are going to rise. So what that means, I think, from an investor perspective, is they have to take a multi-asset strategy. They have to think about across sectors as well as across countries. And I think the other thing that Patrick emphasized is that markets are moving much faster. There's a lot of information for investors to process. And I think that's one of the strengths of Fullerton, and what's important to us is that we put a lot of emphasis on research and analysis when we make our investment decisions. So I think that the last thing to highlight, of course, is that with all of our investment reviews, we always have our FIV quarterly document. It's kind of a companion piece, and it gives you some extra background to a lot of the views that were shared today. And you can access that from our website. There is also a QR code on screen that you can use to access that. So I think without further ado, all that's really left to say is thank you for your time today. We hope you got a lot out of this webinar, and we wish you all a happy new year and a prosperous new year. Thank you.